think tank for the Togethearn group. Today we're just going to go over a little bit more about the CAPM. That is our capital asset pricing model. It's a formula used by many investment firms, broker-dealers, and analysts to not only pick stocks, but also to figure out the risk versus reward of these stocks. And how they do that is basically using the beta of the stock versus how the market, typically the S&P 500, has reacted as well, in an up or down price movement fashion. So we're going to talk about that a little bit. We're going to talk about a way of calculating alpha because that's probably the most fundamental characteristic or variable that's most reliable in picking, good stocks, quote unquote. So after that, we're also going to talk about how exercising options can affect your calls, puts, things like that, and kind of what that looks like and what to expect. So just to get started, I wanted to thank you everybody again for tuning in. We're going to keep this video rather short, but we're going to start off with the beta. Now, we said it before, I'm going to say it again. Beta and the beta coefficient, if you guys have seen that, is pretty much the same thing. So a stock portfolio's beta is a measure of its volatility, all right? And that volatility is benchmarked against the relation of the overall market. This is also known as systematic risk. Now, the overall market is based on the S&P 500 in relation to beta. Now, if a security that has a beta of 1.0 moves in line with the market, a security or portfolio with a beta greater than 1.0 is generally going to be more volatile than the overall market, and the reverse is true with a beta is less than 1.0. So these are very important things. So, for example, if the S&P 500 rises or falls by 10%, a stock with a beta of 1.0 should rise or fall by about 10%. A stock with a beta of 1.5, however, is expected to rise or fall by about 15%. And a stock with a beta of 0.75 is expected to rise or fall by about 7.5%. Okay? So when people advise to buy, sell, or hold securities, this is part of the CAPM method that is used to make these decisions. So what they would do is they would count, or actually what we would do is we would calculate by the expected return and the required return for the security. So say the security is 1, but it rises 15% rather than 10, but the market rose 10. That means it has a positive alpha because it had more reward than it had risk. Okay? So just to move on, and I'm going to get a little bit deeper into that, that's kind of a way, or that is a way of calculating the alpha on a security. Okay? So by subtracting the required return from the expected return for each share, the alpha can be calculated for the security. Positive alpha would indicate a buy recommendation. Okay, so when you see those buy recommendations on, the tickers and analysts say buy, hold, whatever, and you'll have 13 saying this, 8 saying no, 7 saying hold, whatever. That's how they're doing it. They're using the CAPM, the capital asset pricing model. Okay. Now, just to dive a little further into the alpha is the extent to which an asset's or portfolio's annual return exceeds or falls short of its expected returns. So positive alpha is always more desirable. So just to give you an example, if the investment increased by 17% and the investor had an alpha of his portfolio or a beta of his portfolio of 0.7, that's an overall 10% reward over. So that's going to be a positive alpha. So the alpha would be something like 1.1. So it's really just measuring the risk versus reward of not only the stock, but also your portfolio. So you can use this method to kind of see how risky your portfolio is and the expected return you're supposed to be getting. So if it's not kind of lining up, it's probably a good time for you to think about reallocating your investments. So, and that's where asset allocation comes in, and as a key point and variable to use in all of your portfolios and your stock selection strategy. Okay? So I really wanted to take a little dive into that and just understand alpha is the risk versus reward indicator. Beta is the volatility versus the index, or not the index, the market. Okay? So remember those two things. Now, just to move on, I just wanted to talk about what it looks like whenever you have a call about to exercise or expire or put in the same fashion. So, writing a covered call means that you have the 100 shares of the stock because these contracts are based off 100 round lots. Round lots are what's considered a 100 share purchase or holding, if you may say. So say I have 100 shares of ACB, okay? And I got them at 0.95. Well, I think ACB is going to rise, so I'm going to sell a call for $2, okay? As ACB rises, my contract that I just wrote is going to become more and more valuable. You don't have to sell it, okay? You can hold on to it and then put it onto the market for sale. Okay, I'm going to say that again. 100 shares of ACB. This is a covered call I'm talking about right now. And then you can write it because you already have the collateral to write it. And what that's going to look like on your screen is it's going to show negative equity for that contract until it rises to that price or above it to cover all the equity you are writing out to the market. Okay, because remember, call writers have to sell the calls if they are filled. Now, how that works if you just buy a call contract, like a naked one, in a sense, that means you are not using collateral to purchase it. Rather, you are using free money. So when you buy ACB call $1, okay, you're expecting it to go above that dollar, okay? Now, one other thing to consider is how much it costs to buy that contract. If it costs $1 to buy that dollar contract, you're paying 100% premium, hoping that it'll go up. And this is where Greeks come in, okay? Now, we're not going to get into Greeks today, but we will in future videos, and which ones are the most reliable to use depending on how you plan to trade option contracts, because option contracts are generally supposed to be 9-month out things. That's kind of the rule of thumb in the advising world. So, on the put side of things, say you have 100 shares of Boeing, right, at $300. So Boeing has obviously dropped a ton. So you write a put contract for, $179, right, expiring in 9 months. Well, Boeing starts to drop and drop and drop. Again, you're going to have negative equity of the amount you wrote on that covered put option, okay? But as it drops, the value of it will go up. And then if you sell it, that means you can sell it, but if you get to the exercise date, like when it says, oh, your option is exercising or is expiring Friday, you can exercise it, and then you'll be able to sell all those $300 shares at $179, and that in-between gap is what your profit is going to be. Okay? So there's a benefit to writing covered calls, especially on stocks that are under $5. I mean, buy up 100 of those shares, write it covered. You're not going to lose really money. You're just losing the equity you already have. Okay, so it won't impact you near as much. And if, say, there's a technical difficulty with your broker that you're using, or your phone, or your interactive, or your internet drops, it's still going to be okay because you have an exercise date on the expiration date. So it'll auto exercise on most cases because that's how things have been set up recently for options in general. Now, buying a naked put is not having collateral. Both bearish and bullish on call options, and you can be both bearish and bullish on put options. Okay? So it's not puts are bearish, calls are bullish. That is not how that works. Now, and what that means is if I buy a call, a naked call, for instance, then I think the stock's going to go up. If I'm selling a call, it's probably because I think the stock's going to start going down. Now, if I think a stock's going down, I'm bearish. If I think a stock's going up, I'm bullish. Now, do you see the transactional effect in being bearish and bullish on a call contract? Yeah, well, same thing with puts. So if I think the stock's going down, then I will buy a put contract. Now, if I think it stands to go back up, I'm probably going to sell it because I'm bullish on the stock now because I think it's going to go up. So your belief in which direction the stock is going dictates whether you're buying a bullish or bearish position on either side of the contract, okay? So I just wanted to give you got you guys just a little heads up of what to expect in that aspect. Now, say you bought the call and you'd actually like the shares, okay? Well, if you can't afford the shares, you cannot have all of them. You can't just get 79 because that's all you can afford. You have to buy them or be able to afford them in 100 round lots. And round lots is just 100 shares. That's all that means. That's why when you go through the ticker tables and the order books, you'll see that there's a lot of shares or buy bids and asks at $100 or at 100 shares because typically you sell them in round lots. Okay. So say you can't afford it. What they'll do is if you can't afford the contract or buying all the shares, like if you wanted to, so say you bought a call contract on Boeing for 150 and now it's at 169. So you'd have to have a lot of money in order to facilitate that purchase. Typically what will happen is the broker or interactive broker will sell your contract at its intrinsic current market value, meaning by calculating the Greeks, you can see what the actual value of your contract is, whether or not it's going up or down. And that's where the Greeks come into a big play as well. Okay, the delta, the theta, the gamma, rho, vega, all those things are important. I would wager delta is probably one of the most important because that calculation is, or that specific variable is very important in calculating potential upside of a profit. So on the contract. So on our next video, we're going to talk a little bit more about the Greeks, how they affect your contracts, and what it means to, how do I say this? And what it means to see the open volume and the open interest of a contract. Because your contract can go up all at once and be very profitable, but if no one in the market wants to buy it, it's going to be very hard to sell it. So just like if you want to sell, a coffee mug you made and it's worth tons because you made it out of gold, but no one wants to buy it, well, you just got kind of a, just something that's only worth money to you. Same concept. So that's really what I wanted to go over about having positive alphas, looking at the beta, using the beta and the alpha to determine the risk-free reward and the risk-on reward, and the risk versus reward, okay, and how the market affects volatility and how it can be used to determine your stock selection. So that's all I got for you guys today. Again, I wanted it to be a very quick and short video. We can answer questions afterwards. Thank you for everyone who has supported the Togethearn community so far. And I can't wait to see everybody posting profits. Everybody's been having very profitable days lately. So congratulations to all of you guys that have been able to really take advantage of what we're doing here. And I implore everyone to ask their friends and maybe even put some testimonials on Webull, Facebook, Instagram about how we've helped you. We don't ask for much and we give a ton. So thank you again, everybody, for just being a part of what makes this place just so amazing to be a part of.